I think honestly, it's a bit too late. This is why, in a way, that I don't see a way out of this. I mean, this is why I'm short NASDAQ, I'm short the stock market heading into November. There's been a big change in terms of the relative bargaining position between the US and China, which makes it much scarier, I would say, compared to, April, because I think the Chinese are in a stronger position. Therefore, they're much less likely. They're even less likely to capitulate to Trump's win.
David Woo, CEO of David Woo Unbound, a global forum devoted to the promotion of fact-based debates about markets, politics, and economics. It is so wonderful to welcome you back to the show. David, it's been way too long. I think we had you probably at the end of the second quarter. So lots transpired in the third quarter now that we're in the fourth quarter. Great to see you as always. Really appreciate you.
Thanks for having me back on. I love being on this show.
I love having you on this show, and this audience loves hearing from you. And so, since it's been a while, let's start, David, where we always start, with the big picture, the macro view, the framework in which you are looking at the world today. What is on your radar? Where do you see things headed? What is your outlook for the remainder of the year? And as you know, David, on this show, you can take all the time you need to set the table.
No, that's great. Thank you so much for that. I think, for me, when I say for me, I think I can almost speak for the macro community. I think this has not been an easy year. I mean, I think, it was relatively straightforward. I think the first quarter, I think for me, to the extent that I was well positioned ahead of Trump's Liberation Day. So I did well, I think, in terms of my investment strategy. The second quarter, the market came storming back, I got out of the way. So at least I didn't get hurt, but it was tough. Okay. To actually make money, the third quarter, was very difficult because I started to basically I thought the market had gone too far. I'm talking about the stock market, of course. Then I was trying to basically take the other side and lost a bit of money. So, but the good news is that I didn't give up. I came into the fourth quarter thinking that, I think the AI bubble, is vulnerable. The US-China situation, I thought that there could be a surprise, and I was right about that. I was thinking that, the US economy could be set to slow heading into, holiday shopping. And I think, there is growing evidence this could be indeed the case. So all of a sudden I went long. I started to basically go long treasuries from being short treasuries, betting on more aggressive Fed easing, not because inflation is not a problem, but because I thought growth was going to surprise to the downside. And so from that point of view, I feel like, things have been working out quite well lately. I think, with stocks going down, consumer discretionary underperforming staples, treasuries rallying, the dollar doing okay in this environment, I kind of feel like finally things are coming together. And I'm going to the final 6 weeks of the year, continue to be quite defensive. Pessimistic. And then I think this is what I want to talk about, which is why are you so pessimistic? So if you allow me, I'd love to.
Yeah, I want to hear. Yeah.
I think the first part of it is that, in a way, I think, in a way, the market was wrong about the trade war, right? If you think about this, right? Immediately, there's no doubt that tariff has kicked up to the highest level since the Great Depression. Anybody who's taking economics 101 would have said, wow, higher tariff means high inflation, right? And stagflation, or that, reduced corporate profit margin. So either way, tariff was going to be bad news for the stock market, for the bond market. For the economy in general. And yet, incredibly, for the last 6 months, ever since, tariff started to roll in, and we know tariff has been collected, that, that the sort of the negative impact of tariff hasn't been that obvious. Inflation was creeping up, but not that much. Corporate profit margin, in fact, improved dramatically in the second quarter. And the economy until now has been doing okay. Stronger than expected in the second quarter and so on and so forth. In the third quarter, the Atlanta Fed GDP now forecasting is tracking 4%. So so all of a sudden I was like, I was feeling very depressed. And I'm sure a lot of people like me, especially, I, with a PhD in economics, I started my career at the IMF, like working on Wall Street for 20 years. Like I grew up in sort of traditional school of economics, and then that believes that tariff was going to have consequences. You cannot have the cake and eat it too. And then nothing happened, So that was kind of disturbing. And this is also the reason why sort of was so easy for the market to sort of climb the wall of worries, right? I mean, that's why the market just kept going higher, higher, higher. Now, the question is, I am very much of the view that if we haven't seen the negative impact associated with the tariff, it's because, the negative impact has been delayed. And I believe that I think we're literally on the cusp of basically the negative effects started to come through in the data. And that's very much my view, which is that I'm of the view that we're heading towards stagflation. Okay.
Stagflation. Okay.
Now, stagflation. Now, one thing that was indeed quite disturbing, okay, is why until now, sort of like consumer spending has been so strong, right? I mean, you think about this, right? I mean, consumer confidence has been quite low. The employment numbers haven't been all that great. Consumer says that they're depressed, but, retail sales was super strong in July and August. Even the September numbers look like, it's actually quite decent. So like, what the hell is going on here? Like, I am of the view, and I'm increasing of the view, of course, I'm trying to be forward looking here for the next couple of months. I'm increasingly of the view that the strong U.S. consumer spending of the last 2-3 months is no more than just preemptive buying ahead of expected price increase. I think a lot of Americans think that prices are going to go up because this tariff thing is very well telegraphed. I mean, this is not like, back in 2018, like America's never heard of tariff. Like for the last basically 9 months, all they hear every day, all they read about in the newspapers is tariff is going up. Okay. And I think that Americans realize that, what? Yeah, in order to basically if price is going to go up, they should start buying before. And I think, and this is why I think spending has been stronger than expected. I mean, and by the way, but I think it's very clear to me that is now over. I mean, obviously, a lot of this is based on anecdotal evidence. Like, for example, CarMax, right? The biggest used car dealer in the US recently said that, after the tariff went up, and everybody was buying used cars like there's no tomorrow because they all expected prices to go up. But in the last 2 months, demand had just collapsed. Okay. And as a result, they have had to essentially price down the inventory of their used cars by, I think, $1,000 per vehicle. And that's why the stock dropped. Costco CEO, basically said only a few weeks ago that he said Costco is not going to be ramping up, holiday inventory like usual. Okay. All these are little signs that actually things are not going to be that great in the holiday shopping season that starts basically in a couple of weeks' time. Okay. And I think just this week, both Walmart and actually Amazon came out and basically says that, the typical upswing in retail hiring, okay, around the holiday season is going to be also much less, strong than in past years. And then there are a lot of surveys that are suggesting that actually like Gen Z, okay, are going to be pulling back quite sharply in terms of their spending, over the holiday shopping season compared with basically the past few years. And I assume this is because Gen Z, they're younger, they've probably been more affected by the slowing job market, especially the recent college graduates. They're also much more likely to be bumping up against credit card limit and so on and so forth. So there is, I know right now we're in a sort of like a black hole in terms of we have no idea what the data are because of the shutdown. But I think what it feels to me right now is that holiday shopping is going to be very weak, weaker than I think the Fed had been expecting, at least based on the numbers of the last few months. And I think, and especially given that my view is that the shutdown is likely to drag on into November, which will weigh further on sentiment. I think, again, Black Friday, Cyber Monday, you're talking about the concentration of U.S. consumer spending, which is 70% of GDP, into that 1 month. I think, I personally think that November, I think this is what it's going to be. So in a way, if we don't see prices going up a lot, it's not going to be because somehow tariff is not filtering through, but simply because nobody's buying anything.
The demand side of it. Yeah. I also just wonder too, David, like how much has been just loaded up on consumer credit cards, like, are they really that healthy? Like the consumer? I don't know what their balance sheets look like, but.
Yeah, I think the younger people, certainly, I think there is ample evidence to suggest the younger people. I mean, listen, again, the older people, obviously, they tend to be, I'm talking about the older, millennials or for that matter, the boomers, like those are sitting on most of the stock holdings in the country, for example. I mean, they've done well because of the wealth effect. But if you're talking about the younger people, they haven't got a lot of stocks. And they've definitely been spending much more on their credit card. And I think these people clearly are struggling. I mean, that's why I've seen one report lately that says that, Gen Z could actually pull back their holiday shopping by as much as 20%, believe it or not. I think it was Price Waterhouse did a survey. But the point here is that I think this is going to be very interesting. So from that point of view, again, I think Trump got a bit lucky. I mean, I think in the sense that it took much longer, I think, for the sort of the tariff. I mean, of course, there's also the AI bubble that also helped him and so on and so forth. But whatever reason is, I think that, the assumption in the market right now that tariff doesn't matter, that in fact, Trump has reinvented economics, that everything's going to be fine. In fact, most people are expecting a massive, basically, reacceleration in GDP growth next year, and the stock market is going to go up for it. I think a lot of it is based on reading too much of this transitional data, which I think we're about to basically, that are actually irrelevant, because what really matters is that I think, the economic reality is not going to be so great.
Mm-hmm. I heard you earlier in your answer mention stagflation, historically the worst environment for pretty much all asset classes. But can you unpack your thesis for why you see us headed toward a stagflationary environment?
I think stagflation just basically means that, in a way, it's almost inevitable, right? I mean, in a way, because what's going on is that, you've got, we are seeing, if you think about this, you've got, the aging of the American labor force. So the labor force is shrinking. At the same time, obviously, we all know that, essentially the immigration has come to, essentially a standstill. On top of that, Trump is now charging $100,000, per visa for the F1B, basically visa for these Indian workers. On top of that, it's become more and more difficult to get in. So I think, there is no doubt. And then, so there is no doubt at a certain level, there is no question that basically the labor force is going to be growing more slowly going forward as a result of the policy of this president. And I don't think that's going to get reversed anytime soon, right? Meanwhile, this is the question we have to ask ourselves, right? One of the things that, you think, oh, well, obviously there should be beneficiaries from the tariff, right? I mean, the biggest beneficiaries of Trump's trade war ought to be, the so-called import competing industries in the US, right? Those industries that compete against imports, they should be benefiting from, the higher tariffs on imported goods and becoming more competitive. They should be seeing, they should literally be swimming in money right now. Now, let's think about this. What industry what industries are in the so-called import competing sector, right? I mean, obviously manufacturing, right? I mean, and yet, it's incredible, but the last non-farm payroll number we had, manufacturing laid off 12,000 workers in August, which was more than the average of the previous 3 months. Now, within manufacturing, you say, well, America has forgotten how to manufacture stuff, stuff that went to China so many years ago, and they're going to come back and hurry. But there are two industries that should be the biggest beneficiaries because these are established industries that still also have a lot of spare capacity in the US that should be doing a lot better. Which are these two industries? One is autos, okay? And the other is furniture, okay? And most of it these days is North Carolina. And towards
That's where I am, in Raleigh, North Carolina, but High Point, North Carolina, for furniture.
And yet, incredibly, in August, okay, between autos and furniture, these two industries shed 10,000 jobs. Okay. So 85% of the job basically lost to U.S. manufacturing happened in the two industries that should be like the biggest beneficiaries of the tariff. Okay. So what does that tell you? I mean, what it says to me is that actually, if the import competing sectors cannot even benefit from the tariff, then who the hell is going to benefit from the tariff? Like the governor of North Carolina was talking about like how these jobs have gone. It's going to take a lot for them to come back. Like skills that have been lost. Like who the hell are you going to be able, how are you going to get companies that went out of business? You think they're just going to come back and then basically reopen business, especially given the unpredictability of all this stuff right now? So as a result, what will happen is, in a good situation would be that, oh, wow, tariff means that American companies are going to immediately produce a lot more. Okay. But instead, right now, it's like, well, tariffs have gone up, but American companies are not going to be producing more. They're not going to be hiring more people. And guess what? It just means Americans are now going to have to pay higher prices for what they basically purchase from abroad. Okay. And locally too. So essentially what I'm saying to you is that this is the problem right now, which is that, I think, whatever Trump's intention is right now, there is no evidence over the last 6 months this is doing that anybody within the US is benefiting. Because if the import competing sectors are not competing, then, God forbid, I don't know who is.
Gold keeps setting new all-time highs, but price appreciation isn't the only way to profit from owning gold. Monetary Metals is redefining the future of precious metals investing. Instead of paying to store gold, imagine getting paid to own it. With Monetary Metals, you can earn up to 4% on your gold, paid in physical gold. That's right, your ounces grow each month, not just your paper balance. A yield on gold, paid in gold, means you're stacking more ounces every single month. And you still benefit if gold's prices rise. You're earning more gold every month and enjoying potential price appreciation at the same time. Go to monetary-metals.com/Julia to learn more and see how you can start earning 4% on your gold, paid in gold.
Okay.
Yeah, who is benefiting them? Because you point out the manufacturing jobs that were lost, autos, furniture, who is benefiting?
Yeah, no, exactly. I mean, it's hard to say. It's very, very hard to say. The U.S. government has benefited to some extent. They're collecting more tariff, right? I mean, because in a way, it's just a form of tax, right? So the U.S. government's collecting, an extra whatever $30 billion every month in terms of tariff collection, and that's about it. But in the end, that's just essentially a tax. It's just a tax on the economy. That's not doing anything more than that. It's just basically a tax. Okay. And it's a hit on the actual real purchasing power of American people. And right now, again, I just don't see what companies are, small businesses are struggling, larger corporations, right now it's it's hard to say, it's certainly very, very hard to see any companies benefiting right now.
Yeah, I guess. Okay. So on the US-China trade war front, even going back to April, is it fair to say that the US is in a weaker position than we were in April then?
I think so. I think it's unfortunate. I think China is in a relatively stronger position, whereas the US is in a weaker position. I mean, and I never would have thought I was going to say this already in October, because I thought, honestly, back in April, like everybody else, I was sure that the Chinese economy was going to have a hard landing, because it was very clear, in April that the whole Trump's trade war was actually trying to target China, right? And we have to remember the new tariffs, that hit China were both larger and came much earlier than against other countries, right? The average tariffs on Chinese goods right now is almost 60%, up from like 20% at the start of the Trump second presidency. So like you're talking about a very substantial hit, and there are very relatively few exemptions. Like, for Europe and Canada, there are a lot of exemptions, that kind of thing. But against China, there are very few exemptions, and it's a huge hit. I would have thought back in, basically April, I was convinced the Chinese going to have a big problem to recover from this. But, to my surprise, and I think it's to everybody's surprise, that, of all the countries that have seen upward revision in terms of GDP growth forecast by Wall Street this year, nobody has seen more upward revision than China. Like now, Wall Street was expecting China to grow 4%, even less. Okay, back in April, now is expected to grow 4.8% this year, which is barely slower than the 5%, recorded by China last year. And it actually is very, very interesting because it's exactly the opposite of what happened in the US during the same period. Actually, how, just what we said, that the tariff hasn't helped the US at all. But what's interesting is that it hasn't hurt the Chinese that much either. And the reason is because China has been able to actually increase exports elsewhere, to Europe, to Africa, to Southeast Asia, everywhere else, to offset the drop in exports to the US. Now, you might say, well, is it because the Chinese are discounting heavily in order to dump their stuff around the world? If that were the case, Chinese corporate profit growth will be collapsing. And yet, believe it or not, in August, Chinese industrial profit actually expanded 20%, actually, basically following 3 months of decline. What it's basically saying to me is that, yeah, the Chinese economy has slowed a bit. Industrial production was growing at 6% at the start of this year. But guess what? It's still growing at 5% right now. So it's not a very big slowdown. Now, of course, it's too early to say anything for sure. But I am of the view, the reason why the Chinese been able to survive Trump's trade war so far with flying color, I would argue, is the decade-long investment that China has made into factory automation. Okay. People just think, most people think, oh, wow, China is just a bunch of basically cheap labor and all that kind of stuff. The reality is that the Chinese labor force has been shrinking now, okay, in the last 10 years. That is there are fewer people looking for jobs every year. Actually, it's going down. In order to offset that, the Chinese have been investing aggressively in robots.
And AI, I imagine, too.
Yeah. So as a result, today there are 2 million robots in Chinese factories doing the jobs of people. China last year basically installed 300,000 robots alone last year, which is more than the rest of the world combined. So from that point of view, I think it's ironic because China is also, of course, also a leader in AI. So the fact that they are big in factory automation by combining robots and AI, I think they have been the biggest beneficiary of the whole AI revolution, okay? More so than anybody else. And because this whole thing has allowed them to cut costs, to do everything more cheaply. So ironically, this is actually the greatest irony of this thing, which is that, we're sitting, everybody's thinking, oh, wow, so who's going to basically because I think this AI is a total bubble. I'm talking about a bubble in terms of NASDAQ valuation and so on and so forth. But the point here is that there's a lot of debate about who's making use of the AI to increase productivity growth and so on and so forth. Stephen Marin was telling you that, oh, wow, everybody, America, AI is already having a major positive impact productivity growth. Is not clear at all. But where it's very clear, where AI is making a very big difference is in China. And I think that the fact that AI is probably the reason why China has survived Trump's trade war as well as it has until now. And I think, this is actually, and I think this is also the reason why in this latest showdown between the US and China, there's been a big change in terms of the relative bargaining position between the US and China, which makes it much scarier, I would say, compared to, April, because I think the Chinese are in a stronger position. Therefore, they're much less likely. They're even less likely to capitulate to Trump's win.
Wow. It's so fascinating to just like to kind of understand like how the pieces fit together and that this is all part of like a bigger macro story, if you will. From an investor perspective, how is this informing how you're wanting to be positioned in the markets? You're kind of alluding to it earlier, but can you walk us through like how you're thinking about positioning or what you can share from that perspective?
Sure. I mean, you think about this like broadly, like what is the biggest story of the world today? I don't care whether you're a macroeconomist, political scientist, or investor for that matter. The biggest story really is the tech war between US and China. That's it. Okay. Both US and China view, AI as being a must win. Okay. Because they think both sides believe that whoever wins this round, this AI war, is, let's put it this way, will enjoy, I don't want to say hegemony, but certainly let's put it this way, in the rivalry between US and China, there's nothing more important than winning the AI war right now. Now, it's interesting because if you look at the two sides, they have two very, very different strategies about how to go about winning this war, On the US side, it is very clear that Trump's strategy, I'm saying Trump because, he's the president of the United States. Obviously, he's not the only one. But I think Trump understands this very well. And he's been a major, I think, driver behind the US strategy in terms of how to win this war, which is to win this war, the US has to control every choke point of this technology in the supply chain. That is, the US needs to control chip design, large language models, hyperscalers. And the fact that Trump recently has been, had twisted essentially the arm of NVIDIA to invest in Intel, to me, is a very clear sign that Trump also wants to control chip manufacturing. They want to revive Intel in order so that chip manufacturing will come back to the US as well. And then the idea here is that Trump, and I think the reason why they want to do all this, obviously, is to keep China basically behind. But more importantly, if you control all these choke points, and then given how expensive this technology is, because every NVIDIA chip is like $60,000, the only companies that can afford to buy these chips are basically American companies like Microsoft and Amazon that have very deep pockets. Nobody else can afford to buy these chips in scale. And therefore, the idea is, Washington's plan is that down the road in the future, whoever wants to access AI will have to rent AI from American companies. And that is American companies will basically essentially own the rent, basically of the entire industry for as long as the eye can see. So that is, in my view, the American strategy. So what is China's strategy? China's strategy is to commoditize this entire technology so it's going to cost zero. China's strategy is the very, very opposite of the American strategy. That's why the Chinese, large language models are all open source models to the extent you can just literally copy and paste their source codes. That's why there are at least 10 that I know of AI, designer companies in China that are designing their own AI chips. And then they want to sell these chips at 1/10 of the price of NVIDIA chips down the road. Now, why is this important? So US wants to monopolize it in order to maximize the rent. China wants to completely commoditize it so to drive down, the price to zero. What is the market pricing right now? If you think about what NASDAQ's basically massively high elevate valuation of US tech companies. The market is right now assuming that the US is going to win. It's basically pricing a US victory, which to me is certainly not a given. Okay. If you understand what's going on here. And I think this is basically, this to me, it is the biggest, in a way, it's actually ironic, but I would argue the biggest potential problem for the assumption of the AI valuation associated with, NASDAQ right now is, it has to assume that the Chinese will never catch up. Okay. And then if the Chinese were to catch up and soon, then guess what? Then not only NASDAQ, but the entire US economy, the US dollar, everything US will have a big problem. And Trump, and this is what this is about, actually, what is coming down in terms of the showdown between US and China between now and November 1st.
Mm-hmm. So that is right now, that is the macro trade of our generation then.
There's just no doubt. There is no doubt. And what people don't realize is this, right? I mean, it's like, and this is why it's, the market goes up because so Sam Altman says he wants to start selling porn, with, OpenAI, that's almost irrelevant. It's irrelevant. What is much more crucial is this AI race, this AI war. And the reality is this. And this is why this November 1st thing is taking on so much importance for the next basically 10 days. Is that, so you say someone like, because this whole trying to stop China from catching up to the US started under the Biden administration, right? And the architect of the US export sanctions against China was, of course, the former CEO of Google, Eric Schmidt, okay? And he used to say that, the so-called entity list and the tech sanctions and so on and so forth should basically give the US a 2 to 3 year lead over China. And he used to say that in his mind, that's like eternity. And then the idea is listen, in a tech race, technology, everything's changing every single week. If you have the 2 to 3 year lead over somebody, that this is like a massive lead. Okay. Now, I think it is certainly, this is no longer true. Okay. Far from it. Just recently, Jensen Huang, CEO of NVIDIA, said that just 2-3 weeks ago in a podcast that China is now only a nanosecond behind the US in AI and semiconductors. And I think this is extremely, extremely important. Okay. I don't think, Jensen Huang is trying to scare anybody, that kind of thing. He has no reason to do so on and so forth. And he probably has better information than anybody else because he probably goes to China so often that he probably knows what's really going on. Okay. Not the kind of stuff that goes into the Wall Street Journal, the New York Times, but really what is going on behind the scene. So I think, from that point of view, I think the Trump administration is getting extremely nervous. They got very extremely nervous after the Chinese put a ban on the sale of NVIDIA chips in China. Just think about that for a second. What does that mean? For the last 2 years, the Chinese are trying to get their hands on NVIDIA chips, around the world, whatever it took, that kind of thing. Now they said, you know what? Don't even bother to sell them to us because we don't want them anymore. What could that possibly mean? That just simply means that they are now making better chips themselves. Okay. At least they're basically making better chips than whatever they can buy from NVIDIA under the sanction regime. What I'm saying to you, this is actually a very important development. And what I'm saying to you also is that actually, so the Chinese haven't got the lithography machines from ASMLs, the most advanced one, but so that they cannot make miniature chips. But guess what? AI chips is not like making a chip for iPhone 17 Air that has to be very small. AI chip doesn't have to be that small. So therefore, the Chinese, it's not an impediment for the Chinese. Okay. What I'm saying to you is when And this is what the showdown is coming. This is going to get very ugly. And I think the stock market doesn't get it yet, which is that when on September 29th, the Trump administration decided to dramatically expand, the export sanctions against China by essentially passing this relatively obscure rule about companies on the entity list now, that this now, the restrictions would now be extended to also subsidiaries of these companies, that have majority control. So without going into too much into the details, which is boring, but the fact is that before September 29th, there were about 1,000 Chinese companies that were banned from being able to purchase U.S. sensitive technologies. After September 29th, the estimate is that number went up to probably around 3,000, if not 5,000. Okay. So what I'm telling you is that when the Trump administration decided to go down this path, and they did this just before the start of the Chinese, whatever holiday season, whatever it is, because they were trying to sneaky in under the radar, that this, in my view, when they went down this path, that is about as open an acknowledgement as possible that they are starting to get very wary of the Chinese catching up. So they're getting so nervous that they have to basically take out, they have to resort to something as draconian as that to stop the Chinese. And of course, at that point, the Chinese have no choice but to respond in kind, because the Chinese said, well, listen, we will never allow anybody's to set us back, technologically speaking. So if you don't want to sell us what we need to become a better, basically country, we're going to stop selling you, what you need to make F-35 autos, green equipment, whatever it is, that is rare earth. So in a way, the whole rare earth thing is a direct response to the U.S. decision to stop China's technology development. And what I'm saying to you is that this is nothing to do with trade. That's why this latest round of tension between U.S. and China has nothing to do with trade.
It's technology.
It's only about technology.
Interesting.
Okay. And then neither side can back down.
Mm-hmm. I just saw a headline just crossed just now that Treasury Secretary Scott Bessent is going to speak with the Chinese trade counterpart today. It's just a headline, not a full written out article. But if you were to advise the Trump administration, and you are known as a bit of a Trump whisperer on Wall Street, what would you say to them? What would you tell them that they're missing? I imagine we probably just covered it, but if you had that opportunity, what would you say that they're missing?
Listen, I think at this point, to be honest, I think it's a bit too late. I think honestly, it's a bit too late. This is why, in a way, that I don't see a way out of this. This is why I'm short NASDAQ. I'm short the stock market heading into November. Basically first, because because the Chinese rare earth restrictions.
Yeah, why November 1st again? Is there specific?
November 1st is the Chinese rare earth restrictions is scheduled to go into effect on November 1st. And the reason November 1st is because Trump and Xi Jinping are both going to be present at the APEC summit in South Korea at the end of October, basically whatever in 10 days time. So the idea here is that, well, if there's going to be a deal, they're going to work it out in South Korea, so that this is the reason why the Chinese, set the date for November 1st. And Trump, of course, said that, well, if this thing goes into effect on November 1st, then he's going to hit China with additional 100% tariff. Okay, whatever it is. Okay. What I'm saying to you is that Scott Bessent is making a big mistake. And I think, whatever it's, from his standpoint, it's not a mistake, because he thinks it's something else, because he says, listen, he says Chinese cannot be trusted, because he says that when he met with the Chinese, 2-3 months ago in Geneva, when the Chinese agreed to basically, to keep the supply of rare earth flowing, he said it was in exchange for the U.S. agreeing to lowering the tariffs. That's what he said. Okay. Mm-hmm. And he says, well, the U.S. has now raised the tariff, but the Chinese are now trying to basically restrict this. But the Chinese did this rare earth thing has nothing to do with tariff. It is a direct response to the U.S. decision to restrict, access to technology by Chinese firms. So that is the thing. So if Scott Bessent is still trying to approach this whole entire showdown by saying, oh, wow, actually, this is about trade. Okay. I think he's completely missing the point. This has nothing to do with trade. Okay. Nothing to do with trade, only about technology.
Okay. So short the NASDAQ. And the AI bubble bursting here in the US. Walk me through the implications there, because I imagine that has spillover effects elsewhere. How are you thinking about maybe the knock-on effects? Just walk me through the scenario that you see playing out.
Yeah. So I think, there are two reasons why I'm negative in NASDAQ. Number one is that, as I said, this problem between the US and China, which is now coming to a head. Okay. And that, and this is a big problem. Okay. The other is that I think the market, I think there's also an AI bubble. And that the AI bubble has to do with the fact that I think it's not obvious to me, okay, that the revenue growth, okay, the profitability of AI is going to improve as quickly as people are expecting. Let's think about this for a second, right? I mean, I think everybody knows the story by now, which is that, well, it was incredible. This was only a month ago. If you remember, OpenAI, is a company that right now has an annualized revenue of $12 billion. Okay, so this doesn't mean sure that they're ChatGPT and so on and so forth, but they're not making that much money. Okay, so $12 billion. So when a $12 billion company, and we're not even talking about profit, we're just talking about revenue, right? A company basically says that they're going to pay Oracle $300 billion the next 4 or 5 years. Okay, and then Oracle stock goes up 40%, making Larry Ellison one of the second richest man in the world momentarily. That, to me, that's a bubble. Okay. Because I think, this is what it is. Let's be honest. I can understand, at a certain level, I can understand Sam Altman. I mean, because if you think about what do Steve Jobs and Elon Musk have in common? Okay. They're both visionaries. Okay. But both are excellent storytellers. Okay. They were great storytellers because you know what? And guess what? People like Jensen Huang and Sam Altman, they're obviously very good storytellers as well, right? Sam Altman, I mean, to me, it's amazing because how his stories has mesmerized everybody right now. Because the last 6 weeks, the whole AI rally is about how Sam Altman has decided he wants to turn OpenAI into a major hyperscaler. This is a company that has, we were talking about how, let's say, Microsoft, even if they're buying all these chips, at least, it's a very profitable company. And then they're going to, they're paying with cash. Right now, Sam Altman is promising to spend $1 trillion, whatever, the next 5 years. Okay. And the market got very excited about it. And then they're making $12 billion. My problem with this whole OpenAI thing is not about anything else, but about the technology. All I know is this, it took OpenAI 2.5 years after releasing ChatGPT 4.0 to release ChatGPT 5.0. And 5.0 is probably about 20% better than 4.0. Okay. In other words, basically, if it's going to take them another 2.5 years to come up with 6.0, that's going to be 20% better than 5.0, we've got a problem here. You understand? I mean, I think what it says to me is that actually based on the current architecture, okay, of generative AI, we're starting to basically basically bumping up against the plateau of the technology. This is also the reason why Facebook, Meta, decided to delay their all-time great, whatever, their own large language models, the Llama 4, okay, the Meta, because supposedly the improvement is also just incremental. So my problem right now is that it's not, because the market is right now thinking that, OpenAI is going to spend $1 trillion in the next 10 years. But it's not clear to me how OpenAI is going to be able to make enough money to basically pay for all these chips in order to become a major hyperscalers. given that actually the technology, seems to be already essentially running up against diminishing return even before it's taken off. Now, sure. I mean, if we somehow manage to discover, generated, whatever, the artificial general intelligence in 3 years' time, things can change. But we don't know that. I mean, because it's not a continuous thing from where we are right now. That would be something completely different. Okay. And this is my problem. And then on top of that, the problem for OpenAI is the fact that, these days, this is not like Google search. Google search is like 99% of, search goes through Google search. Google search is like they're the best and they're monopoly and so on and so forth because their technology is sort of better than everybody else. And then for years, nobody could even come even close. All right. Right now, like OpenAI has got so many competitors, not even funny. I mean, there are all these basically like internet sites where people actually rank all these different large language models according to their performance metrics and so on and so forth. Like, 3 of them of the top 6, 3 are Americans and 3 are Chinese. Okay. All because of this technique called distillation, which allows all these large language models to copy and paste each other's capabilities. It might take a company 3 years to come up with a new model. It will take only another company months at a fraction of the cost to copy all that new stuff. Okay. And then to replicate it exactly. So what I'm saying to you is that the assumption, okay, right now, this whole AI thing assumes that the technology is going to go through the roof. And that's why, and then therefore the assumption is that if the technology is going to improve so much, then demand is going to go through the roof. So all these companies are getting in there to buy the chips and build up the capacity so that in order to basically be ready for the demand. But right now, to me, the bottleneck is actually the software, the OpenAI of the world. Maybe this is the reason, maybe Sam Altman gets it. This is why he wants to become a hyperscaler. Because maybe he figures that that's the only way he's going to basically make money out of it. But I cannot imagine that Microsoft is too happy about that. By the way, like Microsoft has been basically investing aggressively in data centers, because of their special partnership with OpenAI. They were going to use their data centers to power the OpenAI models. But now OpenAI wants to basically wants to go into Microsoft's business. I just think that there is a lot of bullshit going on. And I cannot imagine, I don't know this as a fact, but it wouldn't surprise me that actually Sam Altman is making lots of enemies actually across Silicon Valley. So what I'm saying to you is that there's an AI bubble. And then there is this whole US-China thing, which is about AI in its own way. And these two things together makes me very wary about the current valuation of the US stock market.
Yeah,
and then
particularly the tech stocks,
the stock market, I think we're going to go right into a recession. There's no doubt about that in my mind.
Got it. Yeah. Okay. I know short selling can be quite challenging, and like markets can go the other way. From a risk management perspective, how do you have to think about a trade like this?
You have to think about it in portfolio, right? Because I mean, I'm trading lots of different things. And I would not just like have one just naked short NASDAQ position. Also, you have to sort of know which level to basically short it at. And then you might want to hedge it from time to time. Nobody's saying shorting is easy. Okay.
Mm-hmm.
But I think, from that point of view, I just think that, for retail investors who are doing this at home, I think if you make some money, I think, in tech, take it out of the table, actually. I mean, especially again, I think the point here is that November 1st is going to be a very big day because, again, there are two very important things. I mean, because I'm not, if I'm wrong, I'll be the first one to say, what, I'm out of this. Okay, I mean, because, every day, when facts change, you got to be prepared to change your mind. So I'm not married to any position, as long as if my investment thesis is no longer true. But the next 2 weeks, there are two very important things to be on the lookout for. One, of course, is, as I said before, will the US and China work it out between now and November 1st? Because if they don't, this is very bearish. Okay. I mean, it's bearish for lots of things, not just basically for tech, but especially bearish for tech. Okay. The second thing is that between now and November 1st, we're going to have, quarterly guidance from Microsoft and Amazon. Okay. I think it's reasonable to assume that I think that their numbers probably going to be okay. Okay. The question is, what's going to be in their guidance in terms of CapEx spending going forward? I think any hint that there could be a slowdown, whatever it is, I think the market is going to be in trouble. Okay. So I think that's what it is, because right now everybody's thinking, oh, well, as long as Microsoft's buying more NVIDIA chip, everything's going to be fine. Because people think, oh, well, Microsoft presumably know what they're doing. If they're buying more of these chips, it's because they think that the underlying demand is strong, right? And then nobody wants to second guess Microsoft, like they should know better than I do about the outlook for demand. So as long as they're buying more, it's going to be fine. But I think, and that's the market psychology right now, which I think is wrong, but it doesn't really matter. But this is why, like, any disappointment, even the smallest disappointment in terms of like potential pullback, I actually think Meta is going to be pulling back on their, because Meta has also been one of the big buyers of these chips. I think they're going to be pulling back. They just recently signed a couple of deals including with Google to rent their computing power, which probably tells me that they're going to be renting this as opposed to buying more of this themselves, because maybe it's less risky. Whatever. We'll see how it goes. My clients are among the biggest hedge funds in the world, macro guys, and so on and so forth. Like, I'm not like saying, oh, well, listen, I'm going to basically, I'm betting on a 20%, 30%, 40% drop. No, that's not what I'm doing. I'm going to basically going in and out, in a sense that I love to basically make 5 or 6%. I love to see a 10% drop, by the way, and then, but I may not actually stick around until the end, that kind of thing. So to me, this is a bubble that is going to definitely go down. But like bubbles, like the NASDAQ, when the NASDAQ bubble burst after the the dot-com bubble, like it took 2.5 years for the bubble to finish bursting. It takes a long time. So
yeah, that's
I think
a good
it's point.
Yeah. I think some people think it's like, oh, it should be instantaneous, but that's a good point. It takes a long time.
It really takes a long time.
Yeah.
Because, like part of it is real, part of it is not real, right? I mean, so you don't know which part is real, which part is not real. And then you don't even know, like, again, because you're selling hope, right? I mean, that's what they're selling.
Mm-hmm.
And look at Tesla. It's a great example, right? I mean, the news cannot be any worse for Tesla, and the stock is trading at a PE like at 150, whatever it is. So clearly, like Elon Musk, people love his storytelling, whatever it is, and and they're willing to give him benefit of doubt. I mean, and that's what it is. I mean, and you have to respect that, by the way, if you're trying to short the market. You got to basically, that's why I respect, and, Jensen Huang as a storyteller. I respect, Sam Altman as a storyteller, even though I tend to agree with Elon Musk that he's a liar too. But that's a different story.
David, before I let you go, what's that risk for you right now that's keeping you up at night? 'Cause, I mean, you look at the world from all different facets.
I think, there's only one thing that really worries me. It's like what Trump said last week, that he was thinking about sending the Tomahawk missiles to Ukraine. I mean, if he does that, that is like really scary. That would be extremely scary. I mean, he's backed away from that a little bit today. Like, last night.
He's supposed to meet with Putin. Yeah.
But I think but again, I don't know. I don't think Putin's going to end this war. Okay, so I don't know what assurance he had from Putin that would, whatever. All I can tell you is this, like, that, Russia invaded Ukraine 3 years ago in order to stop the Tomahawks from being deployed on the Russian border. Because in 2022, it was very obvious that Biden was doing everything he could to get, Ukraine into NATO. And for the Russians, okay, had Ukraine got into NATO, it would have meant that Tomahawk missile launchers would have been deployed directly on the Russian border. And then Putin was not going to have that. And this is the reason why, he decided to invade Ukraine in order to prevent Ukraine from becoming a NATO member, in order to prevent the Tomahawks from being deployed on Russian border. So do you think that after all these, almost 4 years of fighting, that he all of a sudden is going to agree? Okay, fine, yeah. Trump, please send them to Ukraine right now. It would be a completely unacceptable situation for the Russian. They would, as the Russian president said, on Monday, former president Medvedev said, he said that, the problem why these missiles will end very badly for everybody is because since these missiles can carry nuclear warhead, that means that when these missiles are in flight, there's no way for the Russians to know whether they're carrying conventional or nuclear warheads. Okay. And this is, I just hope that Trump has the good sense, to not go down this path, because it's very, very scary. It would be very scary if the U.S. goes in this direction.
Yeah. It will. David, I have to say, I always enjoy our conversations. I love listening to you. I love learning from you. I know this audience does as well. Before we go here, let folks know where they can find and support your work. I am a subscriber to David Woo Unbound, so I hope other folks sign up. I'll leave a link. And any parting thoughts? The floor is all yours.
Yeah, I just think that, I think thank you so much for that. I just think that, listen, I mean, I know I'm negative right now, but I think I think the point here is that, everybody was very negative at the start of the year, and then things got better. But I think, and then in many ways, the Trump got a bit lucky, and then he was able to tackle his way out of some very difficult situation. In a way, I would argue that just like the shutdown in Washington right now, the showdown between U.S. and China is a very tough situation for Trump to tackle out of. Because again, this is not about tariff at 25% or 20% or 15%. This is about the technology leadership. It's about the hegemony. There's so much writing on this right now. And I think, this is something that, this is why I think the market may be overestimating Trump's ability or willingness to tackle again in the situation. So, yes. So we'll see how that goes. Anyway.
David Woo, CEO of David Woo Unbound. Thank you so much. Really appreciate you being so generous with your time, all of your knowledge, your wisdom, helping us all learn and get better. Really appreciate you. Until next time, be well, David.
Thank you. Thank you, Julia.